Nigerian Deposit Insurance Corporation (NDIC) says 99% of bank depositors in the country are fully protected under its enhanced deposit insurance scheme, a strong reassurance amid ongoing financial sector reforms. Managing Director and the Chief Executive Officer, Thompson Oludari, made this known at the 47th Kaduna International Trade Fair in Kaduna State. He urged customers to link their bank verification numbers (BVN) to all accounts to ensure seamless access to insured funds in the event of bank failure. Welcome to Business Point, where we extract the Nigerian economy and the government policies. I am Kike Lomo Okere. The trade fair, organized by the Kaduna Chamber of Commerce, Industry, Mines and Agriculture, focuses on driving economic transformation through sustained local content development, a theme the NDIC says aligned with the financial sector reforms aimed at delivering real results. Here is the coverage breakdown. Under the revised insurance structure, depositors in the deposit money banks, mobile money operators, and non-interest banks are insured up to 5 million naira per depositor per bank. Depositors in payment service bank, microfinance bank, and primary mortgage banks are covered up to 2 million naira per depositor per bank. The NDIC says this expanded coverage now protects about 99% of depositors nationwide, largely small savers and retail customers. The corporation stressed that linking BVN to bank account is no longer optional but essential. In recent bank closure, BVN data enables the NDIC to trace depositors' alternative account and transfer insured funds within days. Closure of Heritage Bank Limited, Union Homes PLC, and ASO Savings and Loans PLC were cited as examples where BVN linked payouts improved efficiency and reduced delay. Beyond insurance, NDIC mandate covers supervision of insured institution, distress resolution, and orderly liquidation of failed bank. It works closely with Central Bank of Nigeria to strengthen risk-based supervision and protect the stability of the financial system. The NDIC says depositors' confidence remains a top priority by increasing coverage limits and tightening verification through BVN linkage. The NDIC is positioning itself to respond faster to bank failure and reduce panic withdrawals. However, public awareness and compliance with BVN linkage will determine how effective this safety net truly becomes. The Central Bank of Nigeria has imposed a 10 million naira fine on a commercial bank that engages unaccredited check printers or personalizer as part of tougher sanction regime to safeguard the nation's clearing system. Under the revised Nigerian check standard and the Nigerian check printers accreditation scheme, any bank found using unapproved printer will not only pay 10 million naira but also withdraw the affected checks from circulation. A repeat violation will attract 20 million naira fine alongside check withdrawal. The Apex Bank is also clamping down on other infractions. Banks that fail or reuse to submit personalized check sample for testing face a 5 million naira penalty. Poor encoding of check or failure to meet mandatory security and quality standard will draw a 10,000 naira fine per check instrument. The directive was convened in a circular signed by the Director of Banking Service, Amisu Abdullahi. The review updates the 2019 sanction framework and is designed to align enforcement with current reality in the banking industry. The CBN says the move is aimed at strengthening the efficiency, credibility, and safety of Nigerian clearing system by ensuring strict compliance with check production and security standards. This is a regulatory warning shot. By raising financial penalty and mandating withdrawal of non-compliance check, the CBN is tightening internal control within commercial banks. The message is clear. Shortcut in security process will no longer be tolerated, with checks, fraud, and document integrity still key concern in the financial system. Stricter enforcement could boost public confidence, but sustained monitoring and transparency compliance checks will determine how effective this sanction proves in practice. Nigeria has again falling short of its 1.5 million barrel per day production quota approved by the Organization of the Petroleum Exporting Countries, extending its trek to underperformance to 6 consecutive months. According to OPEC latest monthly oil market report, Nigeria produced 1.459 million barrel per day in January 2026, up from 1.422 million barrel per day recorded in December 2025. The 38,000 barrel per day increase signal marginal recovery, but not enough to meet the agreed benchmark. The shortfall now stretched from August 2025 through January 2026. Data from the Upstream Petroleum Regulatory Commission shows production dip in December before rebounding slightly in January. Instead of closing the gap, output volatility has persisted despite repeated government assurance to ramp up volumes. A broader review of 2025 figures paints a troubling pattern. Nigeria slightly exceeds its OPEC allocation in only 3 months, that is January, June, and July 2025. For 9 months, output remained below target. Year-on-year, crude oil production declined by more than 80,000 barrels per day. Nigeria opened 2025 strong at 1.54 million barrels per day, surpassing its quota, but February output slipped to 1.47 million barrels per day, and in March it dropped further to 1.40 million barrels per day, one of the widest bank recorded. Temporary rebound in April and May failed to restore consistency, although June-July saw marginal gains above quota. The momentum was not sustained as 2026 unfolds. Expectations are rising. The Dangote refinery has announced it's operating at full capacity of 650,000 barrels per day, increasing pressure on upstream producers to guarantee steady crude oil supply. Meanwhile, the new chief executive of the NUPRC, Eyesan, has unveiled a 3-point agenda focused on production optimization, regulatory efficiency, and sustainable operations. The strategy aligns with the renewed hope agenda of President Bola Ahmed Tinubu's, which targets crude output of 2 million barrels per day by 2027 and 3 million barrels per day by 2030. The Commission plans to recover short in wells, cut production losses, address natural field decline, and accelerate time to first oil without regulatory burden on operators. Analysis shows that Nigerian oil production remains unstable and below potential. Marginal monthly increases cannot mask a persistent structural challenge marked by operational inefficiency, infrastructure constraint, and production losses. With domestic refining capacity expanding and fiscal pressure mounting, consistent output growth is no longer optional. The success of the new production roadmap will depend on execution, security of oil assets, and investors' confidence. Without measurable improvement, Nigeria risks continued revenue gaps and weakened influence within OPEC. Nigeria is pushing an ambitious tax overhaul aimed at raising its tax to GDP ratio from 10% to 18%, matching the Africa average through sweeping legal reform and aggressive digital integration. The reform agenda outlined by tax experts at a PwC Nigerian webinar is structured around two pillars: legislative simplification and technology-driven enforcement. At the heart of the restructuring plan is a major cleanup of Nigerian fragmented tax framework, authorized intend to collapse nearly 60 different taxes into single-digit number of levies. The objective is clear: reduce complexity, lower compliance costs, eliminate duplication, and improve the ease of doing businesses. Nigerian current revenue framework remains heavily dependent on oil receipts, while tax collection cost hovers around 4%, significantly higher than the global average of 1%. The imbalance, expert says, is physically unsustainable. Simplifying the tax code is expected to close loopholes, cut administrative waste, and reduce disputes between taxpayer and authorities. The second leg of the reform is technological. Tax administration is being redesigned around real-time data integration around agencies, automated reporting, and electronic invoicing. The e-invoicing rollout, which began in 2024 under the Nigerian Revenue Service, is being implemented in phases, starting with large taxpayers. Once fully operational, the system will validate transactions instantly, improve reconciliation accuracy, and reduce reliance on manual audits. Electronic filing, fiscalization tools, and automated withholding tax system are expected to plug leaks in value-added tax and other transaction-based revenue areas long plagued by underreporting and rate inconsistency. For businesses, the message is direct: digitize or risk non-compliance in an increasingly automated environment. Beyond improving compliance among existing taxpayers, the reform aims to widen the tax base with enhanced transaction visibility and data sharing authorized, are positioning the system to capture segments of economy that have historically operated below the radar. The linking legal clarity with digital oversight, government hopes to create a transparent, predictable, and data-driven ecosystem. This is more than a tax adjustment. It is a structural reset. If successfully implemented, the reform could stabilize government revenue, reduce oil dependence, and modernize fiscal governance. However, execution will be critical. Digital system must be secure, interoperable, and user-friendly, while legislative consolidation will avoid creating new bottlenecks. The 18% target is achievable, but only if enforcement is consistent, political will is sustained, and businesses fully integrate into the new compliance architecture. The Nigerian Bulk Electricity Trading PLC says only 60 million naira was released from the 858 billion naira appropriated in its 2025 capital budget, a development that exposes the deepening liquidity crisis in Nigerian power sector. Acting Managing Director Johnson Akinowu disclosed this during the agency's 2025 budget performance review and defense of its 2026 proposal before the Senate Committee on Finance. The figure represents a near total funding shortfall, leaving NBET unable to effectively settle obligations to electricity generation companies. And NBET was allocated 858 billion naira to cover tariff shortfalls and outstanding payment to GENCO. Instead, just 60 million naira was released late in the year. Too little to deploy and too late to impact performance due to procurement constraint. The implication is stark. The agency responsible for stabilizing Nigerian electricity markets is operating without financial backing required to keep the system liquid. NBET sits at the center of the electricity value chain. It buys power from generation companies and sells to the distribution companies, ensuring payment flow across the system. When funding gap widens, the entire chain is affected. Nigeria's electricity tariff remains largely non-cost reflective. The approved tariff do not cover the full cost of the generation, transmission and distribution. Distribution companies remit collection to NBET, but those collections fall short of actual market cost. The federal government is expected to bridge the gap through budgetary support and partial risk guarantees. When those releases failed to materialize, NBET absorbed the shock and debt accumulates. In 2025, the Niger Delta Power Holding Limited raised alarm over 600 billion naira owed by NBET, warning that the debt burden was crippling operations. Members of the Senate Committee on Finance expressed worry over the widening financial strain and its potential impact on nationwide electricity supply. Without sustained funding and tariff reform, stakeholders warn that liquidity in the market will continue to weaken, threatening generation output and overall grid stability. This is more than a budget shortfall. It is a signal of structural fragility. NBET's role is critical to maintaining balance in Nigerian electricity market. When appropriated funds are not released, the liquidity chain breaks down. Generation companies struggle, debt rise, and power supply becomes increasingly unstable. Unless tariff reform and consistent government funding close the gap between cost and revenue, Nigerian electricity markets will remain trapped in a circle of debt, intervention, and uncertainty. The Security and Exchange Commission is stepping up its fight against illegal investment scheme, seeking a strategic partnership with the National Orientation Agency to intensify nationwide awareness. Director General of the Security and Exchange Commission, Emma Motomi Agama, made the move during the meeting with NOA Director General Larry Issa Onilu in Abuja. The capital markets regulator says fraudulent investment platforms are spreading rapidly, exploiting economic hardship and limited financial literacy. The SEC acknowledged that enforcement alone is not enough. The new approach prioritizes aggressive public education, taking the message beyond boardrooms and into communities. The NOA brings an expansive grassroots communication structure, town halls, motor parks, religious center, radio and television platforms capable of reaching millions across the country. The SEC believes closer collaboration will ensure Nigerians understand legitimate investment channels, risk associated with unregistered scheme, and how to verify regulated operators. While commending recent progress in the capital market, the NOA stressed that many Nigerians remain unaware of formal investment opportunities. This knowledge gap, officials says, fuel vulnerability to fraudulent scheme. The proposed collaboration will focus on civic education, financial literacy, and promoting responsible investment decision. This shows that illegal schemes thrive where awareness is low and economic pressure is high. The SEC's decision to partner with NOA signals a shift from reactive enforcement to preventive education. If sustained and properly funded, the partnership could significantly reduce Ponzi-related losses. However, lasting impact will depend on consistent messaging, digital monitoring of emerging schemes, and swift prosecution of offenders. In the battle against financial fraud, information may prove to be strongest defense. The gap between Nigerian official markets and parallel market exchange rates narrowed sharply to 77 naira on Thursday as bureau de change operators and banks prepared to access dollars from the reopened Central Bank of Nigeria window. At the official Nigerian foreign exchange market, the naira slipped slightly to 1,353.66 naira per dollar, a 0.35% drop. In the parallel market, the currency strengthened to 1,430 naira, comprising the spread from 92 naira the previous day. The convergence began even before actual dollar allocation were made, signaling that policy communication alone influenced market expectations. Licensed BDC are now permitted to buy foreign exchange from authorized dealers, banks at prevailing market rate, with weekly cap of $150,000 per barrel for eligible retail transaction. Banks are required to conduct full know your customer checks and adhere to risk management standards before selling the BDC. The move aims to formalize retail FX supply, reduce the persistent premium in the parallel market, and improve transparency as well as price discovery. Early market reactions suggest increased confidence in official FX channels, with BDC already approaching banks to understand operational framework ahead of the full implementation. Nigerian external reserve continued their steady rise, reaching $47.53 billion as of February 10, 2026, bolstering the CBN capacity to intervene in the market and support liquidity at the retail level. Analysis shows that narrowing FX gap reflects early market trust in CBN policy and hints at a stabilization of naira. By giving BDCs access to official dollars, the central bank is addressing structural distortion that have inflated parallel market premium and fueled speculation. Sustained impact will depend on timely dollar allocation, strict compliance by banks and BDCs, and effective monitoring to prevent arbitrage. If fully executed, the policy could enhance price discovery, strengthen financial inclusion, and reinforce confidence in Nigerian FX markets. All right, this is where we'll call it a wrap on Business Point today. Join me again next time on Global Television, channel 365 on DSTV and 276 on Star Times. To stay connected, kindly follow us on all our social media platforms using @GlobalTVNG. Till I come your way again, I am Kike Lomo Okeri. I celebrate you all.